$30 billion in canceled chip orders, 400,000 AI processors that will never reach their buyers. That is the opening salvo in what might be the most dramatic supply chain restructuring in semiconductor history.
Welcome back to Asia Tech Macro. I'm Maya. And that bombshell you just heard Alex drop, that's NVIDIA's decision on March 5th to halt all H200 production for the Chinese market and redirect every single TSMC wafer to its next-generation Vera Rubin platform. We're talking about Alibaba, Tencent, ByteDance, all left holding canceled purchase orders.
And the timing here is extraordinary, Maya. Just 2 weeks later, SEMICON China 2026 opens in Shanghai on March 25th with over 1,000 exhibitors, and the theme is basically, we'll build our own AI chip ecosystem, thank you very much. The global semiconductor industry is splitting into two parallel universes right before our eyes.
Okay, let's rewind a bit for context. So back in January, Trump formally approved limited H200 exports to China, right? That was supposed to be the olive branch.
Right, January 13th. But here's what happened next, and this is the part most people missed. Chinese customs authorities essentially told NVIDIA, thanks but no thanks. They informed the company that the chips would not be allowed to enter the country. Then Beijing fine-tuned its messaging in late January, saying Chinese companies can purchase the H200, but should consider local chips first. That's diplomat speak for don't buy American.
Wait, so China rejected its own access to NVIDIA's chips? That's a fascinating strategic move.
It's a power play. Beijing is signaling that it won't be dependent on Washington's permission to build its AI infrastructure. And NVIDIA read the room. Jensen Huang, ever the pragmatist, looked at the situation and said, why am I allocating precious TSMC capacity to chips that might get blocked at the border? Let me redirect everything to Vera Rubin for customers who actually want to pay.
And what a redirect it is. At GTC 2026 on March 16th, Huang dropped some staggering numbers. He expects purchase orders between Blackwell and Vera Rubin to reach $1 trillion through 2027. $1 trillion. That's double his earlier projection of $500 billion.
The Vera Rubin platform is a beast. We're talking about a system made up of 1.3 million components, delivering 10 times more performance per watt than Grace Blackwell. The NVL72 rack pushes 260 terabytes per second of aggregate NVLink bandwidth, which NVIDIA claims exceeds the bandwidth of the entire internet.
That's almost absurd. But the real story isn't just the specs, it's where these chips are going. OpenAI, Google, Microsoft, Meta, they're the primary customers for the Vera Rubin rollout in the second half of 2026. AWS alone will deploy more than 1 million NVIDIA GPUs, spanning Blackwell and Rubin architectures.
And here's where the supply chain math gets really interesting. TSMC's CoWoS advanced packaging, which is the critical bottleneck for every high-end AI accelerator, is being scaled from 75,000 wafers per month to a projected 130,000 by year-end 2026. That's a massive expansion. But NVIDIA has already secured over half of that capacity through 2027.
Over half? So what happens to everyone else?
Exactly the right question. Google reportedly cut its 2026 TPU production target from 4 million to 3 million units specifically because of limited CoWoS access. When the world's second-largest AI chip buyer can't get enough packaging capacity, you know the bottleneck is real.
So we have this incredible situation where the supply side is expanding at an unprecedented rate. TSMC nearly quadrupled CoWoS capacity in 2 years, and it's still not enough. Demand is just that explosive.
The AI infrastructure build-out is consuming silicon at a pace nobody predicted even 18 months ago. Hyperscaler capital expenditure across the top 5 cloud providers is now approaching $700 billion for 2026. That's not a forecast, that's committed spending.
Let's dig into what's happening on the other side of this divide. Because while NVIDIA is redirecting wafers and Jensen Huang is talking about trillion-dollar order books, SEMICON China 2026 just wrapped up in Shanghai, and the message from the Chinese semiconductor industry is very clear. They're not waiting around.
The numbers from SEMICON China tell the story. The global semiconductor market is projected to hit $1.8 trillion by 2030, and China is positioning itself to capture a massive share of that. What really caught my attention was that Chinese firms are now entering the advanced hybrid bonding race, which is the next frontier in advanced packaging beyond what TSMC does with CoWoS. They're not just playing catch-up on legacy nodes anymore. They're investing in the packaging technologies that will define the next generation of AI chips.
And then there's the high silicon bombshell. Huawei's semiconductor subsidiary just unveiled its first self-developed stacked CMOS image sensor, a 50-megapixel chip with AI-enhanced imaging. They partnered with GQ Vision to ship it in a sports camera, but that's just the entry point. The real signal is that HiSilicon can now do stacked architecture design and manufacturing. Chinese CIS firms captured 19% of the global market in 2024, up from 10% in 2020. That trajectory is steep.
I was just reading this morning that the stacked architecture approach dominates about 80% of global CIS production now. So HiSilicon isn't entering a niche market. They're entering the mainstream of imaging semiconductors with a competitive architecture. And here's what connects this back to the NVIDIA story. Every time the US tightens export controls, it creates a stronger incentive for Chinese companies to develop domestic alternatives. The H200 cancellation is just the latest catalyst.
Okay, but devil's advocate here. There's a huge difference between making a camera sensor and making a competitive AI training GPU. Huawei's Ascend 910C is still manufactured by SEMIC on a relatively limited process node. Aren't we overstating China's semiconductor capabilities?
Fair point, and I want to be precise here. China's strength is not in cutting-edge logic at 2 or 3 nanometers. That's still TSMC's domain, and the gap there is real. But China is making remarkable progress in 3 areas that matter enormously. First, mature node capacity. China is adding more semiconductor fab capacity than any other country right now, focused on 28 nanometer and above. Second, advanced packaging, which, as we just discussed, is where a huge amount of AI chip performance actually comes from. And third, the materials and equipment ecosystem. China accounts for the largest share of semiconductor equipment purchases globally.
That equipment spending is wild. Chinese fabs were TSMC's and ASML's biggest customers by revenue last year.
And that creates this incredibly awkward dynamic. The same Western companies whose governments are trying to restrict China's chip capabilities are simultaneously earning their largest revenue shares from Chinese customers. Tokyo Electron, Japan's leading chip equipment maker, generated 43% of its sales from China last quarter, up from 24% a year ago. The export controls haven't reduced China's equipment purchases. They've actually accelerated them as Chinese fabs stockpile tools before potential further restrictions.
That reminds me of what happened with Huawei in 2019. The entity list was supposed to cripple them, and instead it turbocharged their domestic supply chain development.
Exactly the same playbook. And now we're seeing the ripple effects hit the materials market. Gallium prices have more than doubled to around $2,000 per kilogram. China controls 98% of global gallium production and 60% of germanium. Beijing implemented export controls and then a full embargo on U.S. shipments in December 2024.
But didn't they suspend that ban?
They did, technically. China announced it would suspend the ban on gallium, germanium, antimony, and superhard materials exports to the U.S. until November 27, 2026. So it's a temporary reprieve with a very specific expiration date. And even with the suspension, prices remain well above historical averages. The gallium market hit $687 per kilogram in May 2025, over 150% above pre-control levels. It's come down from that peak, but the structural vulnerability is unchanged.
So the materials war is another front in the bifurcation. China controls the upstream inputs, the US and allies control the advanced design tools and equipment, and both sides are racing to reduce their dependency on the other.
That's the cleanest summary I've heard. And both sides are discovering that decoupling is far harder and far more expensive than any politician suggested.
Contrarian corner time, Alex. The consensus view is pretty clear. NVIDIA dominates AI chips, China is locked out of cutting-edge silicon, and the US-led coalition maintains its technological lead through export controls and equipment restrictions. But you've been skeptical of simple narratives for as long as I've known you. What's the contrarian read here?
The contrarian position is this. What if canceling those 400,000 H200 orders and forcing China to go domestic is the single biggest strategic gift Washington could give to Beijing's semiconductor industry? Here's my logic. Before the export controls, Chinese tech companies were happy to buy NVIDIA chips. Why wouldn't they be? The A100, the H100, the H200, they were the best in the world. Chinese AI labs had no real incentive to invest billions developing domestic alternatives when they could just buy American.
So the export controls removed the path of least resistance.
Exactly. And now look at what's happening. Biren Technology, a Chinese AI chip designer founded just 7 years ago, IPO'd in Hong Kong in January, raised $717 million, and surged 76% on its debut. The retail tranche was oversubscribed 2,348 times. That's not just investor enthusiasm. That's a market pricing in the certainty that China will need domestic GPU alternatives.
2,348 times oversubscribed. That's bordering on mania.
Or rational pricing of a structural shift. Baidu's chip unit is lined up for the next Hong Kong AI chip listing. The pipeline is building fast. And the Hong Kong IPO market is forecasting 350 billion Hong Kong dollars in total fundraising for 2026, with AI and semiconductor listings driving the surge.
Okay, but here's my pushback. Even if Chinese AI chip companies are getting funded, they're still limited by what SMIC and other domestic fabs can manufacture. You can't buy an EUV machine from ASML. You're stuck at 7 nanometers at best, and even that requires multiple DUV patterning tricks. The performance gap is real.
That's the conventional wisdom, and it's not wrong on the hardware specs. A Biren BR100 or a Huawei Ascend 910C cannot match an NVIDIA Blackwell chip on raw compute performance. But here's what the contrarians argue, and I think there's real merit to this. The DeepSeek moment proved that algorithmic efficiency can partially compensate for hardware limitations. DeepSeek V3 achieved competitive benchmark performance at a fraction of the training cost. If Chinese AI labs continue to optimize their software stack around inferior hardware, they might reach good enough performance for most commercial applications.
Good enough is a really important concept in technology. VHS beat Betamax. Android outsells iPhone globally.
And China's domestic AI chip market doesn't need to beat NVIDIA. It needs to serve Chinese customers at Chinese prices with zero geopolitical risk. That's a very different competitive bar. Analysts at Goldman Sachs note that the Hang Seng has risen 28% since the DeepSeek catalyst, its best run since 2017. The market is pricing in a scenario where Chinese tech achieves partial self-sufficiency.
There's another angle to the contrarian thesis that I want to bring up: the materials leverage. China's 98% control of gallium and 60% of germanium gives Beijing a counterweapon that's arguably as powerful as America's control of EUV lithography. If the November 2026 suspension expires and China permanently restricts gallium exports, every semiconductor fab in the world that uses gallium nitride or gallium arsenide compounds faces a supply crisis, and those compounds are increasingly critical for power management in AI data centers and for 5G infrastructure.
You're touching on something most semiconductor analysts underappreciate. The chip war isn't just about logic and memory. It's increasingly about the periodic table. China has been systematically tightening controls on critical minerals. We saw it with rare earths, now with gallium and germanium. And Japan's chip equipment companies are caught in the crossfire. China launched an anti-dumping probe into Japanese chip-making materials in January 2026, essentially retaliating against Tokyo's alignment with Washington on export controls.
So Japan is getting squeezed from both sides, Washington pressuring it to restrict export controls to China, and Beijing retaliating by targeting Japanese material imports.
Tokyo Electron's CEO must be having sleepless nights. Your largest customer by revenue is the country your government is trying to restrict. That's an impossible position. And it raises a question that nobody in Washington seems to want to answer honestly. If you push China to develop its own chip ecosystem, and you simultaneously alienate the allies who supply the tools, what exactly is the endgame?
That is the trillion-dollar question, literally. And I notice you haven't given me your answer yet.
Because I genuinely don't know. And I think anyone who claims certainty about how this plays out over the next 5 years is selling something.
Action items time. Given everything we've discussed, the NVIDIA pivot, SEMICON China, the materials war, the bifurcation of the AI chip supply chain, what should investors and business professionals actually be doing?
3 specific actions. First, track TSMC's CoWoS capacity allocation as your single most important leading indicator for the AI trade. TSMC is scaling from 75,000 to 130,000 wafers per month by year-end, but NVIDIA has locked up over half of that through 2027. The key question is who gets the remaining capacity and at what price. Watch TSMC's quarterly earnings calls, specifically any commentary from CEO C.C. Wei on customer allocation. If TSMC starts building additional CoWoS lines beyond the current 130K target, it signals that the AI demand supercycle has even more legs. If they hold steady, it suggests they're seeing potential demand plateauing.
Second,
build a monitoring framework for the November 27, 2026 gallium deadline. China's suspension of its gallium and germanium export ban expires on that date, and the market is not pricing in the tail risk. If the suspension is not renewed, gallium prices could spike well beyond the May 2025 peak of $687 per kilogram. Companies with gallium nitride exposure in their supply chain, think power semiconductors, RF chips, LED manufacturers, could see immediate margin pressure. The companies best positioned are those with diversified material sourcing. MP Materials in the U.S. received a $400 million Pentagon contract specifically to build domestic rare earth and critical mineral processing. Track their quarterly production numbers as a barometer of Western decoupling progress.
and third,
Third, and this is the one most people will overlook,
Watch the Hong Kong AI chip IPO pipeline as a real-time gauge of China's semiconductor self-sufficiency trajectory. Biren's $717 million IPO and 76% first-day surge was the opening act. Baidu's chip unit is next. The pricing and demand for these IPOs tell you exactly how much capital is flowing into China's domestic chip ecosystem. If you see continued oversubscription at premium valuations, the market is telling you that the bifurcation is accelerating. If IPO demand cools, it suggests investors doubt China can close the technology gap. I'd build a simple tracker. List every Chinese AI chip company that files for an IPO, track days to first trade, first-day price action, and oversubscription ratios.
That's a smart framework. Basically, follow the money, follow the materials, and follow the packaging capacity.
Exactly. The semiconductor supply chain is now a three-body problem. You can't analyze NVIDIA without understanding TSMC's packaging constraints. You can't assess China's chip ambitions without tracking the materials war. And you can't predict the materials war without understanding the geopolitical chess game between Washington, Beijing, and Tokyo.
So, stepping back and looking at the big picture, what's the key takeaway from today's episode?
The takeaway is that we are witnessing the birth of two parallel semiconductor ecosystems, one centered on NVIDIA, TSMC, and the Western hyperscalers, running on the most advanced silicon ever created, backed by $1 trillion in committed orders. The other centered on Huawei, SMIC, Biren, and a growing ecosystem of Chinese chip designers and fabs running on less advanced but increasingly capable silicon, backed by Beijing's industrial policy and 98% control of critical materials. Neither ecosystem will collapse, both will coexist, and the companies and investors who understand both sides will have an enormous advantage over those who only follow one.
And if you want the written version with all the data and sources, we publish a free daily newsletter at asiatechmacro.substack.com. Every number we cited today, the CoWoS figures, the gallium pricing, the IPO data, it's all in there with links.
Coming up next, we're going to dive into Japan's semiconductor equipment companies caught in the US-China crossfire. Tokyo Electron, Screen Holdings, Advantest, all facing the same impossible dilemma of their largest customer being their government's strategic rival. The data on revenue exposure is going to surprise you.
Can't wait for that one. Thanks for listening, everyone.
Stay data-driven. Bye.